Hi everyone, once again. Today is Thursday, January 12th, 2023, and today Mahendra Singh, life insurance agent in America, is looking to share amazing concept how you can be one step closer to your financial independence and that you don't need to work 9 to 5. And now Mahendra will explain how it works, and if you feel free to get in touch with us, shoot message, email, or text. We are looking forward to helping you. Mahendra, how are you today?
Awesome, awesome. I'm doing great. How are you, Alex?
I'm so happy being with you today to share these amazing details about financial independence. And I'm pretty sure that most of us would like to be in this scenario and these shoes, right?
Absolutely, absolutely,
And
absolutely. I'm
moreover,
excited.
I'm happy that you will explain and disclose these details with the real numbers and real case scenarios. Of course, we will keep some details covered because of the privacy policy, but all other
Yeah,
numbers will be right. Am I okay?
absolutely, absolutely,
Excellent,
absolutely.
perfect.
Yes.
So, stage is
So,
yours, Makendra.
okay. So welcome everyone again to our weekly podcast. Today is January 12th, and if it's your first time listening to us for the new year, Happy New Year, and I hope your year is off to a bright and resounding start. So today I'm excited to cover one of the key things that we teach our clients, and this is financial independence. And as a company, we pride ourselves with creating the most number of financially independent families in North America. I'm very proud about that, and our company is rated as one of the most trustworthy in that arena. Okay. And my goal today is to show you how we utilize the portfolios that we have with AGF, that's American Growth Funds, AGF Inc., and how those portfolios can actually help you to build a retirement nest egg. That way, you have a lifestyle withdrawal, say for the rest of your life, or for, say, the next 20 years or the next 30 years in retirement, whatever the goal is. And we're going to show you how that is possible. And you can still have money in the end. And you don't need $1 million to start. You don't need $100,000 to start. This is consistent monthly investing. So let's get it started. I'm going to get it started by sharing a slide or two just to show you a hypothetical illustration, and then
Great.
I'll dive into two or three of my client cases to kind of mirror what I'm showing you here. Okay, so on one hand is hypothetical, and on the other hand, how we've made that a reality. Okay. All right. So Alex, I'm going to let me just get my screen share up. Okay. That's great. Okay. So here's let me know if you can see my screen here, Alex. Yes, can you hear me? I actually cannot hear you.
Can you hear me now?
I can hear you now. Yes.
Okay,
Okay.
great.
Okay. Sorry for that interruption.
Hmm.
So Alex, this is an example of a client that is actually investing. This is a household, by the way,
Hmm.
$500 per month. And
Okay.
I've used a growth portfolio to show this example where you invest $500. Think about it, guys. $500 a month is literally $125 per week, right?
Yes. Yes.
We think it's a lot of money, but it's really not that much compared to the things that we can cut back on. So if you think of $500 in perspective, you're looking at maybe less than your car payment in most cases, right?
Yeah. In most
Okay,
cases, yes.
in most cases.
So,
So
Mahendra,
this,
just to be
yeah,
on the same page. So we are talking about a client who start investing from absolute zero level, right? Their first
absolutely.
payment was $500 a month onwards for how many years?
And that is my next slide here.
Okay.
20, so for 20 years straight. So this is a projection that showed the past performance of our funds from 2002 to 2000 and to 2022. This is 20 years of investing. Okay.
Yeah.
And $500 a month, it actually proved with all of the ups and downs in the market, whether it's thick and thin, whether it's a war, global pandemic,
Hmm.
recession, all of that stuff, Bernie Madoff and whoever else on Wall Street, right? Think about it. Amongst all of the uncertainties, we will create a portfolio that could build to as much as 354,000. And you can see that figure on the right-hand corner on my chart.
Yeah.
So
Yeah.
it
Yeah.
says final market value after 20 years of investing. So let's say someone is 40, Alex,
Hmm.
and their goal is to retire by the age of 60.
Yes.
That's the demographic I'm charging after right now, because a 40-year-old probably has a property, maybe a 10-year-old, a 15-year-old, whatever,
Yes.
they have a mortgage, They have a spouse, they have parents, elder parents, and they want to set up their own retirement because they've seen that most people today, most 65-year-olds, more than 50% of them are actually dependent on the system, on
Yeah,
on the government, right? I mean, this is reality. And here we are showing them how they could build a nest egg without having to depend on Social Security.
I agree.
Okay.
Absolutely.
So this portfolio averaged 9.8% annually. So we're not shooting the lights out here. Neither are we diving too low. We're right there on a medium to on a low to medium risk level, producing about 9.8% return. This is over a 20-year period compounded.
Yes.
So the net amount. So if someone asks, well, I'm 40 years old, how much am I really putting out over a 40-year period? Well, you're putting out about 120,500.
Yeah, in 20 years accumulated amount. I agree.
20 years, and you build 354,000. And these numbers would be way higher if we didn't experience the last 3 years, but we cannot erase that, right?
Yes.
So the last 3 years have tested our performance, and you know what? We have delivered for our clients. We have delivered way beyond. So no more than 6,000. So Alex, on another note, people say, well, what about taxes?
Yes, this is the second question.
Well, right now in 2023, the government has increased the tax-free savings limit from 6,000 to 6,500, right?
Nice.
So this contribution is just within the guidelines of the TFSA threshold. So you're investing no more than 6,000 a year.
Yeah.
If we invest this 500 a month, which is 6,000 a year, into your tax-free savings account, all of the accumulation and all of the withdrawal in 20 years is completely 100% tax-free.
Sounds amazing. Too good to be true, but it's reality. I understand.
Reality?
Yes.
Right.
So I've seen here in your chart, January, December 2013, you had total return of 43.4%. This is unbelievable. I've seen here in the 2008 when most of market crashed, it was only 36% down, what is close to nothing, because you know that many companies disappeared from the markets for good. Absolutely. But this negative trend of 36.5% is not bad at all. But when you take a look of this positive trend in 2013 of 43.4%, it's again something that it's close to be unbelievable, right?
Absolutely. I'm glad you pointed that out, Alex. That's a very powerful point, because a lot of people, when you look at the numbers in 2008, a lot of people would have exited the market.
Yes.
They would not have stayed put. And smart investors and the guys who didn't listen to the headlines, right? They say, think with your head, not with the headlines, right?
Yes.
The guys that listened to the headlines, they exited when they hit minus 30%.
Yes.
But the people who were fundamentally sound, and they got a financial education with us, they stayed in the market, hence were able to capitalize on that 43% growth, that upswing in 2013. They were able to take advantage of that bull market.
Yes. And actually, if you acted in 2008 and with a 36% minus, from the moment you sold your shares, you actually realized your loss, and it's final. There is dead end. You cannot do anything anymore, right?
Absolutely, Alex, and you can give a really good live example here, because you're in real estate, and if you sold me a property last year for 1.5 million, and my property is down to 1.3, I don't realize that loss unless I'm selling. Am I right?
Yes, of course.
Exactly, and I'm not.
Same story, right? Or very, very simple. When you have, for example, 2 or 3, buy 2 and you're getting 1 free, for example, tuna can. Why people are buying food with the discounts and they are not willing to buy shares on discount price? So I can never get it. What is the difference? But generally concept is the same.
They say a guy would walk into a store, a Louis Vuitton store, maybe, or buy 2, let's say, Harry Rosen, and if the jackets are 50% off, he would call a friend, and that friend will call another friend, and they all will come together and buy 2 jackets each. But if the markets are down, share prices have plummeted, everybody is running. They're not inviting their friends. They're not calling on anyone to buy.
Yes, you're right.
So I don't. It's a great analogy, right?
Right.
So this is where it calls for financial literacy, right?
100% agree.
And that is something that I do, financial literacy, before I do transactions.
Absolutely.
Okay, that's the way I work. So Can we move to the next page?
Yes, of course.
Yeah, okay, good. So let's go take a look at the portfolio. All right. Now,
Mm-hmm.
one of the things that we do is we do global investing as well. As you can see on the right side, we
Mm-hmm.
we invest in Canada, we look at the UK, we look at Japan, all of the international markets. Okay.
Great.
But let's go down. Let's go down a little bit. I want to show you here a couple of things. If you take a look, Alex,
Mm-hmm.
as you know, if you walk into a bank today, most of
Okay.
their 1 year returns there is negative. Everywhere has been a negative all year 2022. Okay,
Yes, it is.
most of 2022. Now look at our track record. Of course, the 1 year returns are negative, and
Mm-hmm.
AGF has a really good way of managing the downside and capitalizing on the upside as well. But take a look at the 3 year returns and the 5 and the 10 year returns for those who stayed invested.
Just a second. So you want to tell that after 3 years, you will get yield of investment 15.8%, and in 10 years, 15.7%. Am I right? It's a 15.7% accumulation or year over year.
This is the average. This is the average for the time that you have been invested. So for the last 10 years, the average is 15.7.
Mm-hmm.
So
I
so
understand.
imagine in a world where people thought everything was falling apart,
Mm-hmm.
if you were with us, if you were investing with us for the past 10 years, you would have still seen a net positive return on your portfolio,
Yeah, I agree.
right?
It's amazing.
And people ask me, well, what does it cost to manage my money like this? Because this got to be some real professional management, and it is, right?
Yeah, of
What does
course.
it cost? If you look at the last column, it says management expense ratio. Can you see that?
Yes.
It says 2.6 and 2.65 and 2.55, right?
Yes. Yes.
Now,
Yes.
that is the percentage that goes to manage your money with all the expenses involved and everything else that we do from bumper to bumper, paying the
Mm-hmm.
fund managers and paying the advisor. Everything is all captured in that 2.6 and 2.5. But here's the thing. People ask me, so if my 10-year return was 15.7, is it really 15.7 or is it 15.7 minus 2.65?
Mm-hmm. Yes, of course. I
Like,
know.
what is my net return here, right? Because my
Mm-hmm.
commission, the sales charges and everything minus. So here's the thing. Exciting news. The returns that we've posted here are all net of fees.
Wow.
All
Amazing.
right.
Real numbers. Real numbers.
This is real stuff. And I'm not showing a projection here. This is our performance already that we've realized. This is our performance. Okay. So I'm
Yeah.
confident as confident can be. So the other thing is, how do I utilize this now
Yes.
in a portfolio to build, right? To build and also to take out every month. Because I have a lot of clients that are taking 1, 2, 3, 3, 5 a month from their portfolio that they're living off of. Okay.
Yeah.
I mean, they're traveling, they're helping their kids with college, they're helping their grandkids, they're helping out for Christmas, they're going on cruises. Because why? They have, other than CPP and old age security, they got another 3-4 grand coming in every month
Amazing.
from their portfolio,
Excellent.
right?
So, but Mahendra, we are talking about these investments and all these portfolios, but who is the partner company behind who is managing so successfully all these portfolios? Can you give a little bit more details about them?
So AGF is American Growth Fund and our flagship fund as well. AGF has been in business for the last 65 years, one of the most renowned names in the industry, manage global billions of dollars of global pension funds, manages over $15 billion for our company as well. And these guys are the best at what they do because they're the only company in Canada. And I'll reiterate, they are the only company in Canada that has a mandatory co-investment policy. I'll explain what that means.
Oh,
Co-investment policy,
co-investment policy.
co-investment policy, right?
Okay.
What
Yeah.
that means, Alex, is if I am a fund manager, and I'm not, okay, but if I am a fund manager with AGF, I am mandated to invest 2 years of my salary in the fund that I'm managing in AGF
Wow.
funds. So think about putting your money where your mouth is, okay? Think about confidence for the investor now that my fund manager he has my best interests at heart because his own nest egg is sitting where my money is sitting.
Unbelievable.
Think about that. How more transparent can we get? Okay.
I
So
agree.
that is why I invest with AGF because I love their principles of investing. Okay.
I see.
I love their principles of investing. And these fund managers, take a look at their job that they've done. They get us into companies. So, for example, the numbers I've just shown, those numbers are possible because of investments as follows. You look at the right column,
I
it has
see.
all the sectors: energy, financial, industrial, materials, utilities, technology, etc. Okay. On the
Yes.
left side has the companies in those sectors. So we'll invest for you in these companies. You have petroleum company, you have Marathon, Cheniere, you have Ameriprise, you have W.W. Granger. I'm just scrolling through some of the names. You have popular names that we all know. T-Mobile. Who doesn't know T-Mobile, right? I
Of
think
course. So
T-Mobile is
why?
bigger than Bell and Rogers.
Yes.
United Health, Palo Alto, Primerica stock is there. We went as a
Oh, yeah.
company in the last. We went from 2010. We went from $15 a share to last night we were about $143 a share.
Oh, 10 times.
Right.
Amazing.
And we have Corteva, we have Bank of New York Mellon, we have Wyndham Hotels there, we have Qualcomm, Booz Allen, Parker Hannifin, we have Hilton, all these big names, and we can include Canadian corporations in there as well. You see, so this is the where we come, and we show that, look, if you stay with us over the long term, we will manage that side. You don't have to worry about how the sandwich was made, okay?
Yes, of course.
All you have to do is enjoy it. We'll take care of you. I'll advise you. We both are advisors here, but in the back end, we have a team. We have a team that's very sound in what they do. In fact, they travel to the countries where they're investing and meet with the management of those companies before buying the shares.
Mm-hmm.
And in some cases, our guys have to stay in those countries for a period of time to actually experience the lifestyle there and to know what it feels like to consume, to live, to do something, right? So these guys are not just sitting in their chair, picking a stock out in Japan and buying it. No, they go there.
I understand.
Understand? So this is real, proper principles, when it comes to managing money in the right way, right? Now, the best question I get now is people say, well, now it's time to retire. I'm 40. I'm retiring at 60, maybe 5 years sooner, with $354,000 in that account. Now, the question is, I'm having my CPP and my OLED security, but I want to use $24,000 a year. Now, we can change the numbers around in another podcast, but I just went with a very nominal figure, additional $2,000 a month, assuming that they're getting about $1,800 a month from CPP and OLED security. So they're living off of close to $4,000 a month. Okay.
Yes.
Okay. And this is retirement years. So assuming there's no mortgage, there's no dependent children, there's no high debt, you're just in retirement and all you need is income to sustain your life. So we're providing a $2,000 a month withdrawal for a lifestyle. But take a look at this, Alex. Look at this chart. This chart shows on the right side that you would have depleted your capital a long time. You would have depleted your capital over 20 years of withdrawing $24,000 a year from that 354,000. You still have remaining in your portfolio $286,000.
Wow. So actually, we started with 3,054, and if you start using without keeping that basic of 354 investing, you will go on with within 15 years, you will not have anything at all, right? Or close to nothing. But in other hand, if you keep same balance with the taking only 24,000 each year to support your lifestyle with 2,000 a month, you will have after 10 years, 12 years, again, 286. So actually, you deplete only 70,000 and you took 240,000, right? Unbelievable. It's too good to be true. Again.
So if you did the numbers, right? If you did the numbers on this, you see that column has the balance every year, how the balance is depleting. And then you have, so the first year you had 354.
Yes.
Okay. You took 24,000. That second year you're at 345. So the numbers don't add up. So people ask, how come? Well, when we start withdrawing, it doesn't mean that we stopped investing. Okay.
I agree.
So while you're withdrawing, we keep the balance in the account reinvested. So that way, if you look at your 354 minus 24, you're not necessarily down to 330,000. You're at 345, which means we made you back another 15,000. Then you took another 24 the next year, and you're actually up the next year.
Yeah, because you have good performance of your shares in the market, right?
Exactly, right? So you could see year by year how the number actually changes, and it's astonishing for most people to see that after you've used all your capital and you've used additional out of your capital, you've used some of the growth, you're still left with $286,000.
Yes.
So this is very powerful, Alex, because most people don't have a plan. They don't have a GPS, a financial GPS as to where they will be. So imagine this, you have a game plan that from 60 to 80, I'm fully covered. Okay. Now we could go beyond 80. I have portfolios where guys will have money for the rest of their life. They cannot live it out. They cannot use it out. They have more money than month. I have portfolios where, yeah, and I have on the other side, I have portfolios where people start very late, so they will run out in 5 years or 10 years. But at least they got started, right? So if you're thinking, hey, I'm 55 and it's too late, no, it's not too late. With the right type of planning, we could still do something for you, right? So this is really powerful. If you have, unless you have another question, I will divert into one or two of my clients' scenario just to wrap it up.
Yeah. I would like to ask you before that, Mahendra, let's assume that I would like to invest some money in these funds. Right. Can you explain from beginning to the end how that works in a nutshell?
So in a nutshell, if a new investor, if I'm meeting with a new investor and they want to invest, the first thing I have to figure out is what is it they want out of their investment. Their time horizon of investment, whether it's 5 years, 10 years, 20 years, their risk profile. We have a questionnaire which will go over their risk profile to determine what type of investments are suitable for that client. Okay. Then we'll look at the entire demographic of the household. Like we'll do a financial needs analysis to figure out a few things. And what is your financial independence number? First thing I need to figure out is how much money you'll need to retire before I build you your plan. So I know you're going to be short or you're going to be okay.
I see.
So we'll figure out your FIN number, your financial independence number, by doing a financial needs analysis, which will include details about you, your partner, your dependent children, any real estate that you have, any other investments that you have, the taxes you pay every year, etc. We take everything into consideration because we want to look at this on a holistic basis. We want to see how we can help you totally, not just help you in one area. And I agree. In addition to that, Alex, let's say I'm meeting with you and you say, well, you know what, Mahendra, right now things are tough and I only have $200 a month that I can invest. I cannot find $500 a month. Of course, 500 is not mandatory, but let's say you want to invest $500 based on the numbers you've seen. What I'll do is I'll take a look at your current spending. I'll take a look at it and see, okay, are you paying for mortgage insurance? And and I know you can smile about this because the other day we sat with a client who was spending $346 a month for mortgage insurance.
Yes.
And we were able to use that money and double his coverage. Okay.
Yes.
And so we do cost recovery. So whether you're spending on whole life insurance, universal life insurance, mortgage insurance, or very expensive term insurance, or very, very exorbitant amount of money you're paying in house insurance or car insurance, let's get together. Let's figure it out. It may take more than one meeting. And let's see, first of all, how much juice we can squeeze out of your orange. You know, how much can we actually save you? And then you make up the difference. Okay.
I agree.
I think that is a really smart way to start because there is always a way to utilize the existing funds that clients are putting out. And there's more efficient ways of actually putting that to use and also capitalizing on tax credits, which we covered in our prior seminar.
Yes. Yes.
Podcast, rather.
So in that case, let's say somebody has $200 a month.
Right.
Is it firm commitment that you have to have every month 200? What if somebody has to skip that month and they would like to continue month after? Or if somebody wants to increase their payment from 200 this month, they made with more saving, they would like to put 500, but maybe a month after they want again to go back to 200. How it works in that case?
So what I do, right, and that's a great point because I establish a base for clients. So let's say in some cases clients can afford maybe $700 a month, but I may start them out at $500 a month, but I know they could do a little bit more. So what I ask them to do is put money aside. So keep a buffer for your finances, and ever so often, maybe every 6 months, you have an additional amount of money. We can put that extra money into your portfolio, right? That's one. Number two is in the pandemic, we've had quite a few clients that maybe they lost their job, their hours got cut, and their income got slashed in half. So some folks would ask us to drop their monthly amount from 200, reduce it from 200 to 100, or from 100 to 50, or from 500 to 250. So we can do all of that stuff. This is very flexible way of investing. it's not locked in. There's no contract saying we cannot make changes, nothing of that nature. Nothing of that nature.
Great.
So, and also if you were short last year, we can catch up. Like a lot of families, they were short on their education plan for their children. So the government allows you to do 5,000 max in a given year. Some families did nothing last year, or they did half of that amount. So those folks are able to write a check or let us, draft that balance that they can put into their children's education plan.
I see.
So you can make it up. Right?
I have another question, Mahendra. Let's say in this particular scenario, client is taking every month $2,000 or $24,000 a year.
Yeah.
What is a case scenario if that client doesn't need 1, 2, or more months this $2,000? What's going on with these 2,000? They will stay there, or client has to inform you or AGF, I don't want this 2,000 this month. What is the process in that case? Or, for example, I need more than 2,000. I need, because I have some house repairments, I need $5,000. What is the process in that case?
So if there's a need for 5,000 in a single month where you're actually getting only 2,000, we can do an additional one-time withdrawal for 3,000 to top that up. Okay. On the flip side, if you are getting extra money than you actually need, where you didn't need, maybe there are 3-4 months of the year where you didn't really need the additional 2,000 that's coming in, we could actually reinvest that in your portfolio. Same terms, same conditions, everything the same, right? Everything the same, but depends on what age they're doing that withdrawal, because we'll have to look at taxation and stuff. But in this case, there's no taxation implication because this is all considered in a tax-free savings account. So there's nothing to do with taxes here, okay? But if it's an RRSP, and if there is accounts that trigger capital gains and dividends, like a cash account, a cash mutual fund, we'll have to look at the implications there for them before we actually advise them, right? I understand. So we'll take a look. And last question, if client made decision to withdraw all money, okay, how it works in that case? So in this case, Alex, great question, because we've had a case where a client, he had to leave the country and he was never coming back. So we had to liquidate his portfolio. It was in about $70,000. But thankfully, it was all sitting in tax-free savings account. Oh, I see. And I had another client earlier this year. He was helping his daughter to buy a property, and he needed about $40,000 out of his portfolio. And we were able to grab that from his tax-free savings account with no tax implications at all. So obviously, the numbers are going to be different if we're discussing RRSPs, right? Because there's taxes to do in RRSPs, right? I see. But the way we do our planning is I never put all my clients' money just in RRSP. I create a tax-free savings account. We create a short-term savings account, whether it's an emergency fund. So if things happen, let's say there's your engine stalls, your transmission breaks, your car needs an overhaul, you need $2,000, $3,000. Well, let's look at that emergency fund. Let's don't go to your RRSP. We don't need to go to your TFSA right now. Let's look at your short-term account and see what you got over there, and then we can access money from your TFSA if necessary. Worst case, okay? I understand. Great, great. Yeah. And last question. I know it's mandatory to ask. It's not nice to, but what in case your client dies? What will be with these funds? Right. So you're asking very spot on questions, and we've had cases where clients that are holders of tax-free savings account that they passed away, what we're able to do is we're able to change ownership of that account, move that funds into what you call a successor holder. So there is a spouse, let's say it's John and Mary. John dies, then Mary, she's a spouse. Mary, we roll this money over into Mary's name. So that is called a successor holder. So that way, there's no implications otherwise. There's nothing to do with taxes. Obviously, it just changes ownership from John to Mary because of John's death. So all these details could be regulated based on the sign of the contract for investment, or that has to be regulated through family will? So a will is also very important, especially if a client has many other forms of assets and liabilities, and they have dependents and stuff like that. But when it comes to the tax-free savings account, it's pretty simple. Even if you don't have a will, we would put your spouse as a successor holder. At least that is what is advisable. If someone doesn't want to add their spouse, well, we will add their children as a beneficiary. But when there is a spouse, we add her or him as a successor holder. That way, that person just assumes ownership of the account. I understand. And upon passing of that spouse, then obviously, if there's no other spouse in the picture in the future, then that will go to the children, right? So I understand. That is how that works. Pretty simple. No hard and fast rule here. No account is set up without named beneficiaries. Okay. I understand. All right. Yeah. All right. Great. So that is for that. I love your questions. Thank you for explanations. No, you're welcome. And I would like to segue a little bit into two client stories, two of my client stories, very simple client stories, as I am blocking out the names and all that fine details. Okay, so these are clients that are great friends of mine, and they have approved that it's okay for me to share their numbers. Well, it's just numbers anyways. It's not personal details. So this is a client, Alex, that they have invested $53,800. This was money that we actually moved from Scotiabank back in 2013, September.
Okay.
Okay. He retired at the time. And when I met him, he says to me that beginning January 2014, I'd like to start withdrawing $1,200 gross, which really gives him about $1,000 a month net after taxes, because this is an RRSP. Okay. Okay. So Alex, since 2014 January, he's extracted 1,000 net, which is 1,262 gross.
Yes.
Every month without pause. That is a total of $115,000 since 2014 that he's extracted. So let's pause there for a minute.
Yes.
Right? There was $57,000 in total contributions, right? You extracted $115,000 out of that. So how is it possible? Because every single month that we have processed a systematic withdrawal for him, we have also been replenishing the account. Every month, that account it stays invested. Like I said in the beginning, doesn't mean not because you're actually taking out, we stop investing. We're still investing for you while you're extracting, right? So that is why we were able to replenish some of the money that was getting extracted. Now, so 57,500 minus 115,000, right?
He's in negative.
He should have been in a negative, but right now he has almost 20,000 sitting in that account.
Really? You think it's $18,697, right?
Yes.
This is balance value he still has on his account.
And by the way, every person, not everybody deserves the same haircut, right? So likewise, this client, when I met him, he was already retired. So the portfolio that I set up could not be a high growth or aggressive portfolio. It had to be a very low risk, very conservative portfolio. As you can see, the returns were not shooting the lights out. Okay?
No.
Right? Since inception, he made, with all the ups and downs in the markets, he's made, well, in the third quarter, he made 6.64, but he's average right now 4.85.
Yes.
But this ain't anything that's shooting the lights out. This is just an average portfolio. But take a look at that's why I say the power of compounding. Albert Einstein says one of the most powerful things in our universe is compound interest, right?
Yes.
So this is, especially when it works for you, right? So this is a great example that I love to showcase, because he's been withdrawing money since 2014. Okay. So that is amazing. I'd like to share. Now, by the way, I mentioned taxes earlier. Yes, he pays out some taxes every month, but at the end of the year, because of his income bracket, he gets back most of the taxes that were deducted. Because with an RSP, it's mandatory that we deduct a certain amount of taxes, right? So he gets about 20% deducted. So that way he gets back about almost 20% when we file his taxes. So it works out really good for him. So he could go on a cruise after every time he files his tax return, okay? This is another example where client had a severance package. He invested $104,000 in RRSPs. This was back in August of 2019. Had no idea of any pandemic. Had no idea that Russia and Ukraine were going to go after each other. We had no idea of anything going to happen, okay? Nothing. We had no idea millions of people were going to die from COVID. We had no idea. But our company stayed put, investors stayed invested, and we navigated the path for them. But look at this, $104,000. He withdrew $99,000 to date.
Really?
$99,066.22 to date. Alex, he still has $40,000 in that portfolio. He's
from 2019, 20, 21, 20, so in 4 years. And he still has money. It's so heavy withdrawals.
So it's just under so just over 3 years. Just over 3 years. So 3 years.
Actually, if he right? Let's make simple. If he put on saving account, and saving account is giving 0.75% return on your investment, and with withdrawing of 99,000, he put 104,000. He will have today only 5,000, but because it was invested in the smart TV, and not invested by his own, not managed on his own.
Right.
So he spends 0 seconds of his time to navigate his money, and somebody else is managing that. He still has free time,
right,
and he has positive balance of $40,000 on his account. Who doesn't want to have that amount of money?
And I'll highlight that. And Alex, if you think about it for a minute, the bank GIC, okay, let's say it's about 1.5%. Okay, you have to lock it in. By the way, think about that. You lock in $100,000 at 1.5%. Okay, you not only
years you will get 6,000, not more.
Right. Not only you're going to lose money because let's say you're in a 30% tax bracket, you're going to lose 0.3 in taxes. Not only you're going to lose, so now you're down to 1.17% return on a GIC. Not only that, you're going to lose money with inflation. If inflation right now is 4%, minus 4%, you're actually down to about, you're actually compounding. You're actually down to about a 3%. You're down to a negative 3% plus return. Negative. So you're losing to taxes, you're losing to inflation if you own a GIC at this time.
So one very simple question. Why people believe in GICs?
See, Alex, that is a question I wanted to address. Most people that you find they believe in GICs, they're looking for a guarantee. They want a guaranteed path to wealth building. Now, guys, if you understand compounding, a GIC will not guarantee you anything but a loss. It is a guaranteed win for the institution serving you, but it's a guaranteed loss for you, the investor. Because think about it. Let's make the numbers. Let's take it for granted that we have a GIC that's giving us 3% return. Okay. For me to double my money, if I want to double $100,000 with 3% GIC, I'll have to wait 24 years to double that.
Yes.
Now, I haven't seen a GIC produce 3%. So let's say 2% now. 5-year GIC fixed 2%. You would have to wait 36 years to double your money. Now, if I'm 40 years old, I'm thinking, hold on, 40, I gotta be 76 years old to double my money?
Yes, and this for example, $100,000 to become $200,000 after 36 years will be less value than $100,000 today.
Inflation is eating into our money every single day. Inflation is like an invisible taxation on our money. Okay, whether you like it or not, it exists. Okay, you have to have investments that are performing at least 4% over inflation and that can beat that consistently. Okay, if you're not, it means you're not investing with a wise money manager. You don't have a good company on your side, or the advisor you're using, they're just using you for their pocket piece. Okay, so I'm saying it as a reality check. Please wake up. If you have a GIC, we need to talk because you're losing money every single day that you hold it. Okay, you're not capitalizing on the markets at all.
I agree.
Okay, right? And we live in the markets. How are we not capitalizing on the market? We bank with TD, we fill gas at petrol, we buy it from Dollarama, we go to Walmart, we go to Costco, right? Why not invest in the market? That's the market. These companies I just mentioned is the market. We shop every day from Amazon. Okay, that's the market. Buy Amazon, buy Costco, buy Walmart.
Absolutely.
If your bank is not helping you to buy the bank and buy Walmart and Costco, then maybe we need to revise what you're doing.
I agree.
Okay, right.
I have another question, Mahendra. Let's say, because you were talking about RSP tax-free accounts, and for these two kind of accounts, through them you can invest money. But let's say that you would like to invest $60,000, but you have on RSP only $20,000 room, and on TFSA you have only $15,000 room. So altogether it's $35,000, and you have 60,000. So how this balance of $25,000 can be invested? What is a way to do so?
You're asking great questions. So the number one rule when it comes to, so there are two types of plans we invest in. One is registered and one is non-registered. Okay, non-registered we refer to it as cash. Okay, cash mutual funds, cash investments. Okay, they're open investments. So what you do is the number one rule is if you're working, you have a full-time income and you pay taxes. We believe once you have RSP room, first off, max out your RSP room. That's the first thing. So if my RSP room is 20,000, I want to put out of that 60, I want to put 20,000 in my RSPs. That will trigger for me about a $6,000 tax credit. And if I have little children where I'm getting child tax credit, that'll probably boost my child tax credit. All of that stuff. Okay. Number one. Number two, I want to max out my TFSA. So the 15,000 room in my TFSA, I want to max that out. So now I'm up to 35,000 that's invested in registered plans. Okay.
Yes.
The rest of the 25, I want to invest that in a non-registered account, which is a cash account.
Okay.
Right? So we will take that 25, make a one-time contribution in a non-registered account. Okay. And as you create more room in your RSP and your TFSA every year, if it's right to do based on the client's circumstance and their needs, it's possible to move money between accounts from non-registered. You can move money, out of that. And, depends if it makes sense. If it's going to trigger a loss or a gain, we have to figure that out for the client. But only if it makes sense, you can utilize funds that you have sitting in that account in the RSP or in the tax-free savings year over year.
What are the tax implications if you invest in no registered accounts?
So non-registered account, you could trigger capital gains. So, I buy a stock for $10 and I sold that stock for $12. So I have a $2 capital gain. I'll pay tax on 50% of my gain, which is $1. I pay tax on $1. Okay. So on the opposite side, I bought a stock for $10, but it went to $8 when I'm selling. So then I triggered a loss, right? So you trigger a loss, you get to offset losses against gains in a single year, fiscal year. Okay. So if I made $10 on one stock and I lost $5 on another stock, I have a net gain of $5,000. And
I have another question, Mahendra. Are you paying capital gain only in case of selling shares, or you're paying your capital gain based on your yearly performance?
Right. So very good question. So capital gains are paid only upon the liquidation of shares or liquidation in terms of real estate. I sell my property, an investment property that I bought for $500,000. I sell it for $1 million. Then I have a $500,000 gain, right? Half of it is taxable. Same thing here. I bought a stock for $50. I sold the stock for $80. I made $30. $15 is the capital gain.
I see.
Right. Capital gain is 30, sorry, but the taxable portion is 15, right? So a gain or a loss is only realized upon sale of that security.
I have another question. Sorry, because it's really a very good topic. And now we are talking about personal accounts, but what in case you have corporation? Can you invest money through corporation, and what the consequences are in that case?
So with a yes, you can invest money in a corporation, but with a corporation, there are different funds that we would utilize. Not to get too technical on this podcast, but they're what you call C-class, corporate T-class funds, which is a corporation class funds in mutual funds category that you can use to invest in money in the name of a corporation. That way, any losses or gains are borne by the corporation, not you, the individual investor.
I see.
Right. So
are same returns and gains or gain pennies totally different?
Oh yeah, I mean, in terms of performance. So depending on what we're doing for the corporation and the needs of the funds, we may invest in something that's maybe higher growth, maybe lower growth, maybe conservative. It all depends on the time frame and everything that we're looking at. So that will determine how much return we make for a client. Because if you stayed in the market for 10 years versus 3 years, chances are over 10 years we will get a much better return than 3 years, right? So it all depends not only on the funds, but time in the market.
And taxation applications will be only in case if you realize and sell the shares, and you have again capital gain, right?
Yeah.
So same system is applicable no matter it's on personal name or corporation.
Right. Now there is some differences when it comes to withdrawing money in the corporation class funds, the corporate class funds. And one of the advantages is you actually don't take your growth in the beginning. You could actually start withdrawing principal. That way you don't pay the taxes when you're still operating. Let's say you're still operating your business and you have, let's say, $150,000 income. And now you don't want to withdraw your growth and having to declare that and pay taxes on the growth. Okay. So what you want to do is if you want to savor your money, you want to preserve your wealth, you want to actually take starting from the principal.
Oh.
So you take your own principal, it's tax-free.
Amazing.
And later on, as your income goes down, your income decelerates and you're now winding down into actual retirement and your income is lower, maybe that would be a better time to start withdrawing, So, and then, everybody runs their business differently, Alex. Some folks pay themselves a lot from the corporation. Some folks pay themselves very minimally. So if the owner, if the director is only paying himself, $20,000 a year, then yeah, it may make sense start taking money out. Doesn't matter, because the taxes may not be that significant. But if you're getting paid $100,000 a year from the corporation, 75 or 100,000, I'm just using a number, then it might make sense to go the other way, where you actually start taking from the principal instead of the growth. Okay. Right. So we can cover more of the metrics with corporate class and stuff in another podcast, because there's some investors out there that are not just looking for themselves. They want to have money grow in their corporation as well. Right. For tax purposes. Okay.
Amazing.
Yeah. All right. So this is on the personal side. And I think before we close, can I just show you on my other my other client, actually,
Mm-hmm.
so I showed the monthly accumulation. Then I showed a nominal amount, 57,000. Now I'm
Mm-hmm.
going bigger. I'm showing you a client that we invested back in 2019, October. We invested 417,000 for him.
Mm-hmm.
Okay. We've averaged 10.88% after everything that has happened in the last 3 years. We have averaged 10.88% for this investor. He has grown his money from 417 to 583,000
Oh,
from
almost
October 2019.
33%. Yeah, more than 30%.
Mhm.
It's amazing.
So, see, this is why I go for AGF investments and their funds, because they're very principled people. They know what they're doing. They study the markets. They don't act on the news. Okay. They
Mm-hmm.
have better sources of it. By the time, most investors that are buying their own stocks, they read the daily news and they read CP24. Well, the thing is, if you're making decisions off of the news, then you're late,
You're right.
right? You have to have information geniuses in the background that can generate information before it actually hits the media,
Of course.
before people start making decisions. So we have access to all of those experts that do that.
Yeah, you
We
have to
have
act proactively, definitely.
PhDs and MBs. We have masters. We have a ton of masters, a ton of PhDs in our back office. That's what they do. They
And
analyze
Mahendra,
data,
sorry for
right?
interruption, but I
Sure.
because now I'm looking at these numbers. These $417,000 was invested in October 2019.
Right.
So if you made in 3 years, because October 16, 2022 is 3 years and 2 months, right?
Yeah.
So that
Yeah.
means that your average yearly yield on 417,000 per average was almost $50,000 year
Yeah.
over year
Yeah.
in
Yeah.
last 3 years,
Yeah.
and you didn't spend single second managing that money.
And put it in perspective, this individual, he makes about 85,000 a year. So the money his portfolio made him is almost like having, well, I don't know anybody makes 50,000 on a side hustle. Okay. So if you had to go part-time, if you had to work part-time to make 50,000, think about how many hours you have to go work. It's a burnout, right? So
Yes.
so this is an additional, man, this is the perfect example of saying, you know what? We can help you have your money work for you. Make money work for you, right? All right,
Unbelievable.
put yourself on the right side of the quadrant where you're either a business owner or you're an investor. Okay. And that's where the rich have positioned themselves. That's where the wealthy are. They invest wisely. Okay. And they don't invest with the headlines.
Yeah.
Most people will sell their stock tomorrow morning if they hear Amazon stock prices plummeted by a dollar, or
Yeah.
or
Or Tesla.
cost or Tesla, right? So this is what people do. They make very uninformed decisions. They don't have an advisor, and that's why they don't accumulate as much wealth as the person who has an advisor, who has a company like AGF and Primerica on their left side. So we feel the heart of the person and we work with them step by step and give them a roadmap to achieve their goals and dreams. Okay, Alex, I hope
And
this is
I have,
sufficient.
yes, I have a last question. Sorry, because this
Mhm.
is very common questions for the people. Let's say that somebody invested on their own through TFSA or through RSP, and they used regular bank app. For example, Scotiabank, I know they have investment software that you can use online,
Yeah,
but you
yeah.
don't, and you have control in which shares you would like to purchase. But let's say that that kind of investor changed their mind after watching this podcast, and they're saying, okay, I don't want to have my investments invested on my own through the bank. I would like to get in touch with these guys, and I want them to give me proper guidance where to invest this money that they can make more money than I'm making right now. What is the process in that case?
So in terms of making a switch, right?
Yes.
So the way I do this is when I have clients that have portfolios elsewhere, whether they're with brokerage house or they're with a TD or RBC Dominion or TD Wells or CIBC Wood Gundy or BMO Nesbitt Burns, one of those guys. What we'll do is sit down, right? We'll actually do a financial needs analysis. We'll do a Morningstar analysis and show our performance in the last 10, 15, 20 years. We'll
Mm-hmm.
show that we have come through the test of times. We'll show all the great performance and the resilience of how we manage money. And then we'll look at what their portfolio has done over the last 5 or 10 or however many years they've had it. And we'll do a
Mm-hmm.
side-by-side comparison. If it makes sense, we can help that client to actually do a transfer. So what I mean by that is we're able to do an application online. We're able to submit a transfer request to TD, Bank of Nova Scotia, BMO, wherever the money is. And we're able to have that money come over into an AGF portfolio.
I see.
And that is a simple process that we take care of that. The client does literally nothing. The client all have to do is just give me their attention, maybe 20 minutes of their time. And that pretty simple process, pretty simple.
Excellent.
And
And very
yeah,
last, if somebody
yeah.
has line of credit, not
Mhm,
willing to sell a property, but have line of credit,
mhm,
and it makes sense to invest
mhm,
because right now
mhm,
interest rates and line of credits are reaching over 10%. So to make it in surplus, you have to invest in high risk, high
mhm,
ratio risk in investments.
mhm,
But when everything comes back to the normal,
mhm.
what is the process of switching these funds from equity line of credit to your company?
So I mean, there is a lot of stipulations around that because you're borrowing to invest, and investments have no guarantee. These type of investments, they have great track record, like 9,
Hmm.
10. I'm showing you over 10% return for my client here, but this was not guaranteed in the beginning when I met him. I could not guarantee that, right?
Hmm.
If I say I'm guaranteeing, I'm like, I cannot guarantee that. But then their line of credit would come with, a certain percentage. So now may not be the right time, like you're saying, but in the future, as the rates go back down and we're normalized, and let's say you have a home equity line for 3 to 4%, it might make sense to invest. I mean, I wouldn't say aggressively, more on a moderate scale, because we don't want too much of fluctuations for this client, especially the fact that we want to keep them making more than what they're paying on the line of credit.
Yes.
That way they see a positive return. Otherwise, it makes
Yes.
no sense doing it, right?
Absolutely.
So borrowing to invest, there's a lot of different specimens. We have to take a look at different areas, their financial well-being, look at everything else, the whole picture with their mortgage and what debts they have and all that before I make certain decisions for them, in terms of their risk profile, right?
So this is also
But it is
switching
possible.
is also possible, right?
Switching is possible also. Yeah, yeah, it is
Great.
possible. We'll have to take a look
Mahendra,
at the entire.
thank you for your time today. And
You're welcome.
I will not take too much more time of you because I know you're
No
busy as
worries.
well. But I would like to thank you for your time today, spending almost 1 hour in details explanation how it works. And I believe
Yes,
that it will
yes,
be very useful, informative for people who like to invest. And looking forward to get in touch with any potential investors for deep diving their
yes,
personal cases and to
yes.
help them to be as soon as financially independent as possible.
Absolutely. And it's my honor, Alex, to come on here once again and spend some time with our audience and yourself, and share some of the knowledge that we've learned. And also, guys, we're open to meeting, to giving you a complimentary financial needs analysis if that's what you're looking for. And it's in brand new year. I'm pretty sure we can help you in some way to achieve your goals and dreams that you set out in the beginning of January. So thank you again for your time. Have a great day.
Thank you as well, Mahendra. Have a good day. Bye bye.